All right, welcome everyone, and thank you for joining us for today's meeting on the Allianz Premium Plus event and Allianz Income Solutions. My name is Tom Vukovic, President of U.S. Advisors Insurance. As always, these monthly calls we host, we're committed to providing you with great ideas and tools that you can take back and use into your practice. Today, we really want to focus on a couple of the strongest increasing income solutions unique to Allianz to address your clients' inflationary concerns and concerns about market volatility. Our featured speaker today is one of our great partners, Bill Strife, national wholesaler with Allianz Life. Bill is going to share with you today details on the Premium Plus event, and he will highlight two of the best-selling industry-leading annuities, the Allianz Benefit Control Annuity and the Allianz 222 Annuity. Bill will also demonstrate for you ways to position and enter into the conversation with your clients. And not only will these solutions demonstrate the strongest increasing income option for your clients, but additionally, he will show how Allianz has increased the premium bonus. For example, on the Allianz 222, that bonus has been increased up to 47%, as you can see on the screen there. So no better time than now to take advantage of these solutions, and really excited to introduce Bill. So at this point, I'd like to introduce Bill, hand things over to Allianz National Wholesaler, Bill Strife. Thank you, Bill.
All right. Thanks a lot, Tom, and thank you guys for joining us. Proud to be a part of the U.S. Advisors Insurance Group today. So a couple things about me. He mentioned it, but I've been with Allianz Life. I'm one of the national external wholesalers. I work directly with all of you in the field. So if you guys ever need me to come out there and spend some time, I'd be happy to do that with you. I will include my number as well. But we have a promotion. So in the 21 years I've been there, this is the biggest promotion that we've ever run. In fact, it is the first time, Tom, that we've ever run a double promotion. So we're calling it hit a double bullseye this summer. So what are the dates? They're up there on the screen for those of you that are called in. It's July 9th through August 26th. So for the next 20 days, you have an opportunity to give your clients a very nice bonus on a couple of income products. So before we get started, I want to ask you, a couple of questions here. When you guys are out there in the field and you guys are thinking about it, what is the biggest fear in retirement? What do people typically say? Running out of money. So if you look at it back in I think it was February, March of 2015, my wife and I got Time magazine in the mail. In fact, it was this very magazine suggesting the first person born could live to 142 years old. Now, when I go around the country, I do a lot of client events for advisors, and that's what I start with. What's the biggest fear in retirement? And I do because if you look at it, in 1900, Tom, the average life expectancy in the United States was 47 years old, 47. And what is the life expectancy today? It's about 78, 76 or so for men, and around 80 to 81 for women, roughly. And so why is that important? Well, if you look at it, people are living longer. So in 2015, this child or a child like it would have lived to, right now it would be about 9 years old. About 130 years plus left to live, according to them. And so when I asked people that, I said, how many people think that that's possible? And you know how many hands go up, Tom? Zero. Rarely does a hand go up unless they're just trying to be, have fun or be funny. And but if you look at it, there was a woman in France who lived to be 122. My great-grandfather lived to be 103, and my last grandmother passed away last May at nearly 98 years old. So why do we talk about the biggest fear, and why does this matter for these products? Well, for ABC and for 222, you can't outlive the income. No matter how long you live, you cannot outlive the income. So with that, I'm going to go ahead and get started. So we're going to start off with the 222. There's a couple ways that you can get a bonus, two ways to get an income increase that we'll talk about today, and a couple ways to get a death benefit. That does vary based on state, but there's some details in here that I think you're going to want to cover. In addition to that, we will cover how index lock works. In other words, Allianz is I think the only company out there at this moment that does offer locking gains on participation rates. And I'll talk about the 1 year, 2 year, and 5 year participation rates, where you can lock in the gains or set a low target and capture those gains even if the market's going up, down, and sideways like it is today. So in fact, we're looking at 0 through age 80 for the issue ages on this contract, $20,000 to start, whether qualified or not. And this is a promotion. Again, it ends on August 26th. And so you have 18 months to fund these contracts, meaning if you write it on August 26th, you have until February 2026 to add premium to this contract if it makes sense to you. In addition to that, both contracts will have a 10% free withdrawal, which is pretty standard in the industry. And we'll talk about a few of the indexing options as well. And there are some of the details as far as the surrender charges and lump sum, death benefit, that kind of thing. So we'll cover this in more detail as we move forward here today. Here are some of the indexes, Tom. So for you and your team, if you're looking for opportunities, we see many different indexing options that you've got here. We've got the S&P index, pretty standard in the industry. What is not standard in the industry is the multi-year point-to-point. So we've got Bloomberg, PIMCO, BlackRock, and S&P futures. And the annual point-to-point, the 2-year and the 5-year, those are the opportunities where you can lock in the gains really mid-year if you wanted to, which I think is very, very unique in the industry. So 2 ways to receive a bonus. So as Tom mentioned, the biggest bonus that we've ever seen, in fact, like I said, I've been at the company for 21, almost 22 years, and we've got some very, very nice bonuses here, and 47 is the biggest that I've ever seen. So how does this work? You put in $100,000, and on the accumulation value side, meaning the walk-away side, that's the $100,000 that goes into the contract, and no bonus on the accumulation side. The PIV, or what we call the protected income value side, known as the PIV, you get a 47% bonus. You get that day one, and for all premiums added for 18 months. And what does that do? That gives you a higher income base, essentially. So at a certain point, we'll show an example. We take out a income withdrawal for your clients. They'll get an income for the rest of their life, but on a much higher value. And so that's what the bonus is there to do, is increase the income value. Second way to get a bonus is the interest rate bonus. So it's 150% of whatever the index returns. So for example, in this first year, we see a 3% return. You get 150% bonus. Half of that is going to push you up to 4.5% as a credit on the income side, and on the accumulation side, you get a 3% credit. Second year, you got nothing, no returns, in other words, but you didn't lose any value, of course, on the PIV value. And then the third year, you have a 2% return with a 1% bonus that nets you out a 3% yield on the PIV, or the income side. So that's those are the two bonuses, the 2 ways you can get a bonus on this. So what does it look like in real terms? Well, you put in $100,000 today, you get a 47% bonus. And I'll walk you through some returns. So in the second year, you got a 3% return. We give you the credit bonus on top of that. That's 4.5 compounded on top of 147,000. That gets you to 153,000 and change. And you get a 4.5% bonus the following year. Net, couple years with no returns. Just hypothetical, by the way. No, not based on any historicals. In the 6th year, you had 167,000 in income value. And by the 10th year, Tom, now you're at $183,000, $183,268 in total. So from that, the 2 ways to get an income, which leads us into the income phase. So here's how that works. If we take that $183,000 and we turn on the income, let's say we're in our 60s, we're going to get 5% of that as an individual. If you do a joint payout, husband and wife, you're going to get 4.5%. So just remember this rule of thumb. If you're starting income and your clients in their 60s, they're going to get 5%. 70s, 5.5%. 80s, 80 plus is 6%. If it is a joint income, remember, guys, it's going to be a 0.5 point less. That's based off the youngest of the 2 clients, okay, the youngest of the 2 pays. So the income. So the first year, now we're in our 11th year. By the way, for the 222, it's a product where you have to wait that 10 years to turn on the income. And so as Tom had mentioned, I will position some of these products for you. The 222 is really designed for somebody that's going to do one of 2 things. Either A, wait 10 years and then turn on the income stream, or B, pass this on to their beneficiaries. In most states, you get the full PIV over a 5-year period at death. There are 11 or 12 states with both on the ABC and 222. It's a formulated death benefit, but I'll get into some of that detail a little bit later. So for example, now here we are, we start off our income, and this is of course based, if you look at the bottom here, 183,000, that example that we had, that's 100 grand put in 10 years ago. Now we're at 183 and change. Now here we have a client that's turning on income, and they're gonna get 9,163 the first year. A couple of years with no returns, let's say. It's the third year, finally we get some returns in the market. Your payment goes from 9,100 to 95 and change, 9,500 and change, I should say. And that payment will continue to go up. Now, here we are in, let's say, the 20th year. So you bought this, back 20 years ago, and you have 10 years worth of payments. Now you're at $11,091. Even if the accumulation value goes to zero, not only do the payouts continue, guys, it continues to grow. Okay, so as I said earlier, that person that would have lived to, let's say, over 100 years old, like my great-grandfather, you get income for the rest of your life on these products. And that's really what this is retirement insurance, essentially, both ABC and 222. All right, so we have the income multiplier. I want to take a little time on this because I think this is one of the very best reasons to actually buy this contract. So what am I talking about? What is the income multiplier? How do I get it? Well, let's say, for example, you have $10,000 of income, and you go into a nursing home, hospital, or assisted living facility for 90 out of 120 consecutive days. We will double your income as long as there's accumulation value in the contract. Okay, so the example I always like to use is you turn on the income, you have $10,000 coming in, and let's say you do a joint payout, and you let's say you have a car accident, you're in the hospital for say 6-7 months. We'll double the income. Let's say you leave the hospital, and 4 years later, your spouse cannot perform 2 out of 6 activities of daily living: eating, bathing, dressing, toileting, and so on. She's at home. She's confined. We'll then redouble that $10,000. So it'll go up to $20,000 for her again too. So I said that quickly. I want to slow it down, and I'll give you the example again. Turn on the income. You got $10,000 coming in. You get a car accident. You're in their nursing home for 7 months. It goes to $20,000 after 90 days, and you leave after 7 months. At that point, then it goes back down to 10 grand. 4 years later, your wife cannot perform activities of daily living. Maybe that had grown to 22,000. Let's say 12,000. We'll double that to $24,000 as long as there's accumulation value, until the accumulation value goes to zero. And typically that'll go to zero in 4 to 5 years, depending on how old you are. So with that, that's the income doubler. So basically what we're saying here, Tom, is you have an opportunity to basically get a double payment, so more money when you need it the most, and that's called the income multiplier. All right, so as I said earlier, you can lock in returns throughout the year. Now, you're probably not familiar with this idea, but you can lock in gains on the participation rate indexes. And I want to share that little bit of the stats with you. So what value do our customers typically choose to lock in? Well, I'll give you an example. Just the other day, Thursday, I was in Boise, Idaho. And an advisor had it was a different product, but had 12% return that he could lock in. I think it was on $40,000. They ended up locking in that return that particular day. So they could have waited till the end of just before the end of the anniversary, locked in the returns. But in this case, this gentleman locked in a 12+% return. So he would have fallen in this grid. He'd have fallen right in that 12% category for his client. But the average return of lock-ins is 5.63%. That's the average credit amount, that's account value of an FIA allocated with an active index lock. And I'll show you how that works. I'll show you how to do it as well. But the average return is the most likely return that they lock in is anywhere from that 3 to 5% return area. So how do we actually do that? If we choose these participation rate indexes, how does that actually work? There's 2 ways to do it. You have the manual lock, Tom, and that's going to give you an opportunity to basically lock in interest rates during a crediting period, and I mean like today. or you can do something called auto lock, where you set an upper target, a lower target, or actually both. So there's an opportunity to lock in, to set a high target or a low target, and not actually manually lock it in, which means if the target, let's say, for example, here's the perfect example. Let's say that currently your returns for this particular participation rate index, Bloomberg or PIMCO, whatever it is currently sitting at 7.77%. You can actually lock in, you can set a high target at 12, meaning when the market hits 12%, it'll automatically lock at 12%, or whatever the ending amount is on that particular anniversary. So, or that particular day. So let's say you set a high target at 12, but the actual return for the day finishes at 12.1. That'll be the lock-in. But sometimes it's 11.9 will be the finish of the day for that index. And then even though you had an upper target at 12, it might have finished at 11.9 or 11.8 for that day. The lower target, and by the way, I'm going to just say this in practice. Most people don't choose an upper target. What most people choose is a lower target. So I'll give you an example. Here again, it's the return to date is 7.77%. And by the way, you'll see these reports on your website. If you're writing Allianz business, you just go to your main production page, and you'll see how people have gotten returns and what their returns are. So this is very easy to use. But the lower target at 7.77%, we set a low target here at 7. I usually recommend a cushion of maybe 1%, or 6.77 as the low target. But in this example, and it's just an example, the low target is 7. What does that mean? That means that if that index happens to drop to 7, Tom, your clients would realize a 7% return, depending on what that index closed at that time of the day. Why would somebody set a low target, not just lock in the 7.77? It's because you want to set a low target at 7, thinking the opportunity that this 7.77 might go up. Maybe it goes up to 8, 9, or 10, 12. And so instead of just manually locking like they've done down here, as a second example, they have an opportunity for that 7.7 to actually increase. So that's one way to do it. Auto lock by setting an either upper or a lower target. And again, in practice, not many people set an upper target. Why would you? The lower target is most commonly used. And as a general rule, it's kind of like this. Let's say you're at 7.77 and you're month 9, and you want to look here. You may manually lock it in at 7.7. That's certainly an option. But you want to take more advantage of the upside, and so you're going to lock in you're going to set a low target at 7, thinking you have more upside. So that's when you use the low target. Again, in practice, not many people that I'm aware of use an upper target. It's typically a lower target, so you don't lock in, you don't lose the gains. Because if you're month 9 and that index drops to say 0, and you set a low target at 7, you're going to have a happy client. Why? Because you just locked in returns when other people that didn't pay attention and didn't lock in the returns or set a low target, they potentially got nothing. Okay, so that's something to note about the auto lock example. So the manual lock, this is the one that's probably the most common. Here we have an example. You go to your list of participation rate indexes. You discover Mary Johnson has an 8.9% opportunity. You can click on the target request. You want to do a manual lock, and she's going to lock in approximately 8.9%. Again, I say approximately because the market might finish at 9.1 that particular day. Okay, so as long as you get that in by 4 p.m. Eastern time, we will lock it in on that date. If you happen to lock it in at, let's say, any time after 4 p.m. Eastern time on that date, or let's say on a Friday afternoon, it'll be the returns will be locked in the following business day, as long as the market's open. So that's a little bit about index lock. Now I want to talk about the multi-year strategies, because these are the ones where you can actually choose the lock-in features. So it's on the participation rate indexes only. We have 3 generally on our products. It's the 1-year point-to-point, the 2-year point-to-point, and the 5-year point-to-point. Now, a couple things I'll point out here is, let's say, for example, you choose a 5-year point-to-point. First, why would you do that? Well, you're going to get a higher participation rate. And let's say if you lock it in the 3rd year here, Let's say the index returned 10%. We're going to multiply that times 280, so it's a 28% lock-in return. And then even though it's a 5-year point-to-point, I call it a modified 5, meaning on the anniversary here now in the 4th year, you can choose whatever index you want, even if it's interest only. But there's one downside on the 5-year point-to-point, so I'll just point out the white elephant in the room, and that is this. If you choose a 5-year point-to-point and get no returns, you cannot lock in a 0 in any one of these years. The good news on the 1-year point-to-point or the 2-year is if you get no returns, you're only stuck at a 1-year point-to-point or a 2-year period versus a 5-year period. So it's possible it could get a 0% return for those collectively for those 5 years. Unlikely, but possible nonetheless. So there's a plus and upside. You get a higher par. The downside is the risk is you might get a 0 for all 5 of those years. Again, unlikely, but possible nonetheless. All right, so with that, that is the 222. I want to now switch over to the ABC contract. So with that, we are going to switch over now to the ABC contract. Before I do, Tom, this might be a good time to maybe take a moment for any questions or anything like that, or any questions that you may have.
No questions at this time, Bill.
Okay, great. All right. So we'll get on to the ABC annuity. This is our #1 selling product, absolutely right now, and it's #1 in the industry. A couple things before I close today. We've got a few more minutes here left on this product. You will see some similarities, however, Tom. But I want to point out a couple things. My name, of course, is Bill Strife, as he said. If you have any questions, you certainly can call me directly at 612-321-1518. However, your first line of defense is Andrew Casilius with U.S. Advisors Insurance, and his direct phone number is 800-303-4977, extension 6194. Andrew Casilius, 800-303-4977, 6194 is his extension. All right, start over on real quickly on ABC. This is a 32% bonus, as I said. This product is really designed for immediate income if you want it at your 50 years of age or older, or it's going to give you the flexibility to turn income on any month that you want to. So as we were talking about, you heard me say it, but now you can see it. Issue age is 0 through age 80, 20,000 minimum to start, 10% free withdrawals, and flexibility for 18 months. Again, why is that important on ABC and 222? Because you are going to take advantage of that 47% bonus on 222 and 32% bonus advantage for the next 18 months. If your client does add premium, again, it is flexible for 18 months. Here's just a couple other features that we had mentioned as well. And where I was at, and you guys couldn't see it, this is on this 2 bonus to help you grow PIV slide. So the first bonus, of course, as we talked about, that's the 32% for 18 months. The second bonus, this is going to be interesting. I've got a slide to show you, but on the returns on this one are quite interesting. And they are because if, for example, you get a 4% return, we're going to credit 2% to your accumulation value. That's an opportunity. Or you can get a 10% credit on your PIV value. And I want to show you an example of how that works. So where we were just about to get into this, where you guys couldn't see it, what's the PIV? The value of the lifetime withdrawals will be based off of this. 100,000 goes in, you get a 32% bonus. Let's say 10 years goes by, you're at 200,000. That's going to be your income base, or in most states, your death benefit over a 5-year period. So those are the 2 bonuses that you get on this ABC annuity. And here's the example that I was mentioning. So we have 2 options. You could take the balanced side, the interest bonus option of the balanced side, and if that means if you put in 100,000 accumulation value, you might get a 4% return in the market. Your accumulation value will receive the 4% credit, Tom. The PIV will receive a 6% credit. That's the balanced side. But let me say it this way. Probably 90+% of the people that choose this contract, most advisors will choose the accelerated option. And it's for the reasons that I mentioned earlier. So if you have a 4% return, you're going to get a 50% credit added to the accumulation value. So instead of a 4% credit added to accumulation, that's your walkaway value in 10 years as an owner, or death benefit value in most states, you're going to get a 2%. You're going to get a 4% credit, 2% credit added to the accumulation value, and we're going to get a 10% credit added to the PIV. Why is the math like that? 4% return times 2.5 or 250%. That's a 10% credit on top of your accelerated balance. Now, one thing I can say to you is this slide may sound confusing to you, but it did for me when I first looked at this about 4 or 5 years ago when we came out with this contract. If they want a bigger, like say death benefit, or they want a bigger income value, you're going to choose the accelerated side. It gives you more of a boost, more upside potential. Whereas if you're looking at the balance side, let's say they get an inheritance and they decide, hey, maybe I want a higher accumulation value. This goes from an income product to more of a death benefit product or walkaway. That's why you may shift to the balance side. So if it does sound confusing, just know that 90+% of the people that buy this contract will choose the accelerated side. And why? Because they want the PIV balance to be higher. So here's kind of a quick example that I will show you guys how this works. So first, the most likely scenario that they'll choose is the accelerated side. And when you fill in the applications, the ABC annuity, you fill that in. If it says the balance side, we'll literally call you to make sure that that's in fact what you wanted. Okay. So one of the things I can show you is you put in $100,000, and you get a 4% credit. We're going to credit you 50% of that on the accumulation side. That's a 2% net. So after 1 year, you have $102,000 in accumulation value. But on the PIV side, the income side, which is really why people buy this contract, you're getting a 32% bonus, Tom. And in addition to that, you get a 4% credit in the market. We'll multiply that times 2.5. That's where that example I mentioned, you get a 10% compounded credit on top of $132,000. So what's your net after 1 year? Again, with just a 4% return, your income value would be $145,200. So this is the main reason why people buy that. The balance side, here is what you get. $100,000 goes in. You get a 4% credit on your accumulation side as well. So you're at 104. So you can see it's higher than the 102 on the accelerated side. But you get a 4% credit times 150% of whatever the market returns. So this looks like the 222. You get a 6% credit, you're at $139,200. So again, what do people mainly choose, Tom? They choose the accelerated side. And why? Because it gives them a higher income base versus the balance side, which gives them a higher accumulation base. Okay, so if life changes where you bought this for income and now you get an inheritance, you can switch over that contract year to year on the balance side. So that's just something quickly to note. So which is the better option for your client? Well, on the accelerated side, the enhanced opportunity is really for the income. So as you can see here, your accumulation value in this example is lower, but you have $189,000 income base after 10 years. Whereas the balance side, you got $115,000. Again, just a hypothetical example. $115,000 after 10 years, you can walk away as the owner. But you got $164,000. That's your income base. So if you're turning on income, which would you choose? Or the accelerated side? The balance side would be more for, let's say, walkaway money, or maybe beneficiaries that for whatever reason want the lump sum at death. So here are the payout factors on this contract. So typically, what people will do is turn on income at age 60 or 70. So let's say they turn income on at age 70. Then you got 4.75 as a drawdown percentage, or 4.25, Tom, on a joint payout. So if your example on ABC, let's say you turn on the income, now you have $10,000 in income coming in, you get a 3% credit, but during the payout phase, just like 222, you still get 150% bonus during the payout phase. So on 222, just to reiterate, 150% of the return to market, both during the deferral phase and during the payout phase. With ABC, it's a little different. You get up to 250% during the deferral phase, and then when you click on it, turn on the income, you're going to get 150% of whatever the credit return is. So, for example, if you chose the S&P and you got a 3% return, we're going to give you a 50% credit on top of that. That's 4.5, or 10,000 times 1.04745. It's a $10,450,000 payment that will never go down, and you can never outlive it. So an example here, you got a year with no returns. Now here you are in the 8th year, you get a 5% return, you get a 7.5% increase. You're at 11 and change. Year 6, you get a 4% credit. You get a 6% net credit on top of it with the bonus. Now you're at 11,908, and that payment will continue for the rest of your life, even if the account value goes to 0. So if your account value went to 0, Tom, and you get a 4% return on, let's say, the 20th year during the payout phase, will increase your payment. So that is how that works. And just as a quick example here, I've got a $300,000 case. They put the money in, and they started the income in year 7. The average return here is 3%. They started off and the income was $26,930, and now they have $70,000 in income after the 23rd year, for a total lifetime income. And this is a conservative average. Hypothetical example assumes life expectancy of 65-year-olds, like 21 years. It says 23 here, but I think for a 65-year-old it's actually 21. Total lifetime income on that $300,000 drop in, Tom, was just over $1 million in this example. So that is how that works. Now the income multiplier that we saw in the 222 is also on the ABC. Now there is a slight difference here. As you see, it's eligible after the 5th contract year, so after the 5th year. And so I want to just point that out. So if you buy this ABC annuity and you decide you want to turn on immediate income, just make sure if you go in a nursing home, hospital, or assisted living facility, that payment will not double until the 5th year. And again, as long as you have accumulation value. So let's play this out. Let's say you put in a few $100,000, you buy it, and let's say in the 6th year you turn on income, Tom. You're getting $20,000 of income. And let's say you or your spouses cannot perform 2 out of 6 activities of daily living. We'll double it to $40,000. And for the next 3 years, it grows to $43,000. At that point, she either leaves the nursing home or cannot perform. She still cannot perform 2 out of 6 activities of daily living, let's say, but the accumulation value went to 0. So we'll split this in half from $43,000 down to $21,500. Then the question I have is, can that payment still continue? The answer is yes. In fact, if the market goes up, Tom, the payments will go up as well. So what is the biggest difference between the ABC contract here? This actually starts in the 5th year, whereas the 222, remember, you have to wait 10 years to turn on income, and then that's when the income doubler could be available. So those are a couple of different features on how the income multiplier works. So it's basically a long-term care benefit, essentially, when you need the money the most. So here are some of the participation rate indexes. You have the multi-year point-to-point, just like we mentioned before. So there are some very, very nice options there, and a lot of opportunity for volatility index as well with participation rates. So death benefit, you get the lesser of the protected income value, or 250% of the accumulation value. So what does that say in layman's terms? You put in $100,000. You're essentially capped in most states now. You're capped at 2. So if you put in $100,000, say $50,000, it grows to $100,000. The max you can get is 250% of the accumulation value. So it's $100,000, and let's say your PIV value grew to $300,000. Your death benefit cap over 5 years capped at 250. I don't think that would happen sooner than probably 15 years. So this formula might come into play for a younger client, Tom. Let's say if you buy it at 60 or earlier. After 65, they're really running out of years to live, so it's possible that can come into play. It's basically a death benefit cap. Or you could take the lump sum in accumulation value. That's what the beneficiary can get. They can take a lump sum if they wanted to, and that's, of course, without the bonus. So we covered the how to be a lock star already. It works much in the same way. As I said, the 5.63 is the average return that people have locked in this year. This is on the 1 year and a 2 year point to point. So you can do the manual and auto lock just like you could on the 222. So just know that ABC and 222 have the auto lock. So with that, I want to close this out, and I want to give you kind of a quick reminder here. So first of all, the dates again are through August 26th. So essentially, 3 weeks from today would be the August 26th. That moves on a Tuesday. That'd be the last day to submit an application. You can do it online as late as 11:59 p.m. on Central Time on August 26th. So who do you call? You can certainly call Andrew Casilius here again at this number, which is 800-303-4977, extension 6194. So I think that's just about time. Tom Vukovic, I want to thank you, U.S. Advisors Insurance. I do appreciate your partnership. You guys have been wonderful, and anything else we can do for you, please give me a call and let me know. With that, Tom, any further questions or any other questions on the products?
Yeah, I just want to thank you again, Bill, and thank everyone on our call. Our sales team at U.S. Advisors will be following up within the next day to provide you these tools, resources. If you have clients in mind right now that you think this would be a great solution for, don't wait. Give us a call. We'd love to assist putting a proposal together with you for your clients. Like Bill said, this promotion is running through August 26th. So no better time than now to take advantage of these solutions. Again, our number's right there, 800-303-4977. Andrew Casilius is at extension 6194. He's our senior annuity consultant. And I really want to thank everyone for participating today. I want to thank, again, our partner, special guest, Bill Strife at Allianz Life. And wish everyone a terrific day and a great rest of the week. Thank you so much.
Thank you, Tom. Yep. Take care.
Bye-bye now. Have a great day.